Hello, everyone, and thank you today for joining us on our latest installment of our Thought Leadership series. Today, we're going to be learning about investment and retirement basics. My name is Sean Whalen. I'm a certified financial planner at Asset Strategy Advisors, and my colleague John Gentry is joining me as well. In this presentation, we're going to discuss the basics of investment planning. We'll start by discussing some fundamental investment concepts. Then we'll review some of the investment options that are available to you and consider some general investment strategies. Finally, we'll spend some time discussing how you might go about allocating your investment dollars. In the end, we hope that this overview will assist you in thinking about your own investment needs and may help you determine whether you might benefit from working with a financial planning professional. To begin, let me pose a question to the audience. What does investing mean to you? So this question can mean a lot of different things to a lot of different people. But before I get into the details of the presentation, I just want to quickly go over some of our firm bios as well as our individual bios. Asset Strategy Advisors, we help two sectors of the investment public. We help individuals with their retirement planning, investment, wealth management. And John helps our institutional and corporate clients with their 401k, 403b, help them with their retirement income planning, risk management, so on and so forth. John Gentry has been in the financial services industry for over 30 years, and he's the head of our retirement services at Asset Strategy Advisors. Again, he helps small to large companies with their 401k plan design, as well as their participants in the plans. And as I mentioned, myself, certified financial planner, director of business development, and been in the financial services industry for over 20 years. So again, going back to my question, what does investing mean to you? Some of you may associate investing with speculation, some gambling on the volatility of the markets, especially given the recent volatility of the last few months. And the hope is to obtain potentially higher returns. For example, trying to time the market in order to make a quick profit. Others may see investing as more of a long-term methodical effort to save for the future. And that's some of the points that John will bring up about 401ks and retirement planning and so on and so forth. In fact, investing is a little of both. All investing involves a certain amount of risk, including the potential loss of principal. And there can't be no ironclad guarantee that any investment strategy will be successful. Investing also involves the potential growth of your money over time. Consider investing a carefully planned and prepared approach to managing and accumulating money. And again, that's where we kind of come in to help with a financial plan to give you some, bigger ideas, bigger pictures on how to attain your financial goals versus maybe just doing quick trades and investing and so on and so forth. So again, this presentation is going over the basics. So maybe if you don't need this presentation, I'm sure there's a brother or sister or a son or daughter or some family member that might enjoy this as well. So please feel free to share this presentation with them. Again, like I said, consider the investing as a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. So we're going into the effects of inflation. An important concept to understand when it comes to investing is the impact on inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual rate of inflation since 1914 has been approximately 3%. At 3% annual inflation, something that costs $100 today would cost $181 in 20 years. Let's say you have $200,000 stashed under your mattress. Assuming a 3% annual inflation rate, that $200,000 will only buy you about $108,000 worth of goods and services in about 20 years. And less than $60,000 if you held that same money under the mattress for 40 years. This means that if your investments aren't keeping pace with inflation, you're actually losing purchasing power each year. It also means that the real rate of return on your investments may actually be less than you think, something you'll need to take into account.
And Sean, that's a really good point. In retirement investing, one of the most common mistakes that we see is investing too conservatively, and the result is a failure to keep pace with inflation over time. And on the next slide, we'll see what the effects of compound returns can be over time to help offset the effects of inflation.
The effects of compounding. Inflation, as we just spoke about, has the general effect of reducing the real value of investments over time. Compounding has the exact opposite effect. Anyone who has a savings account understands the basics of this. And basically, the next time interest is calculated, it's based on the increased value of your account. So in effect, you earn interest on your interest. Many people, however, don't fully appreciate the impact that compounding earnings can have, especially over a long period of time. Let's say you invest $5,000 a year for 30 years, and after 30 years, you'll have invested a total of $150,000. Yet, assuming your funds grow at exactly 6% each year, because of this compounding, you're going to have over $395,000 after 30 years. That's pretty powerful. And then another quick little rule of thumb for you is the rule of 72. It's a quick way to help you estimate how long it will take for an investment to double in value through compounding. Divide the number 72 by the rate at which the investment will increase in value, and that result is the number of years that it will take the investment to double. For example, if the expected annual return of an investment is 3%, it's going to take you approximately 24 years for the investment to double in value. You can also use that rule of 72 to estimate the rate of interest you'll need to double your investments in a given number of years. Just divide 72 by the number of years. For example, in order for an investment to double in value in 4 years, you'll need an annual return of 18%.
This slide, Sean, is a good retirement illustration that shows what you might expect to occur if you save $400 a month in your 401k.
Yeah, very, very, very valid point. So this slide just describes, sooner rather than later in terms of the investing. So the sooner you start investing, the more time your investments have for potential growth, just like that compounding example we gave in the last slide. Waiting too long can make it very difficult to catch up. For example, if you invest $3,000 at the end of each year, starting when you're 20 years old, you'll have accumulated almost $680,000 at a 6% annual growth rate, and not including tax, by age 66. If you wait until age 35 and start investing $3,000 annually, you'll accumulate only about $254,000. If you wait until age 45 to start investing, you'll accumulate about $120,000 by the time you're 66 years old. The point of this is, we don't want to discourage anybody. It's never too late. It's simply trying to illustrate the importance of acting sooner rather than later.
Yeah, and since retirement is typically your longest term goal, this highlights the importance of signing up for your plan as soon as you become eligible.
And these are the pieces that John, my colleague John Gentry, helps all the time with our, corporate retirement sponsors, as well as the participants, kind of give them some guidance of, upping their contribution levels and things like that. So, please feel free to, we'll have our contact information at the end, but please feel free to reach out to us if you have any questions on your current situation and, looking for some ideas. This next slide is just about identifying goals and time horizons. The first step in any plan, like we discussed earlier, is, what are you investing for? Many of us invest to accumulate funds for retirement or for a child's education. Others invest for short-term goals, perhaps maybe a down payment on a home or a new car. Still others invest to build a fund that they can access for unanticipated financial needs, such as illness, accident, job loss, things of those nature. Of course, you may have all of these things as investment goals or something that I haven't even mentioned, but if you don't have multiple goals, think about how you might prioritize them. So once you've identified and prioritized your investment goals, consider the time horizon associated with each goal. Generally speaking, all else being equal, the longer your time horizon is, the more aggressively you may be able to invest. That is, investments carry more risks, will tend to have more appropriate returns for those long-term kind of horizons versus shorter-term instruments. And the reason why is the longer the investment horizon, the more time you'll have to recover from any investment losses. So, we'll go into some of the risk tolerance on the next slide, but we have some tools available to us on our website to capture our risk scores. if you guys are interested in, taking a look and getting your personal risk score. Just go visit assetstrategy.com and look at risk score, and you'll be able to use that to get your own personal risk score. So again, getting into risk tolerance, the world of investing is very subjective. So the investment plan that's right for you depends largely upon the level of comfort that you have when it comes to risk. You can't completely avoid risk when it comes to investing, but it's possible for you to manage it. So again, knowing what your risk is the first step. There are two aspects of risk tolerance to consider: the capacity of your investment plan itself to absorb losses, and how comfortable you are personally with risk. The first aspect can be quantified. The more flexibility your investment plan has when it comes to potential loss, the more risk your plan can tolerate. For example, as we've discussed, a long investment time horizon may allow you to take on more risk than a short-term horizon. Second aspect, how comfortable you are personally with risk, is more of an emotional measure and depends on many factors, including your objectives, life stage, personality, investment experience. Some investors are comfortable with high degree of risk, while others can tolerate only minimal risk. Your individual risk tolerance is an important factor in deciding which individual investments are appropriate for you, as well as how your investment dollars can be allocated among different investment classes. Investors are typically grouped into three categories for purposes of discussing risk tolerance: aggressive, those who have a high degree of risk tolerance; moderate, those willing to accept some degree of risk; and conservative, those who are risk averse. Here's the kind of a relationship between risk and return. You can see on this graph here that Treasury bills have the least amount of return on the left axis, and then on the bottom axis, it shows you that they have the least amount of risk. CDs are a little higher up on the return ladder, and they carry a little more risk. Same thing, government bonds, corporate bonds, so on and so forth. So you get up to options and futures. That's where you might get your best potential return potential, but you're also taking on a lot more risk doing those investments. So again, knowing your personal risk score, using tools like we have on our website, assetstrategy.com/risk score, that will help you really understand where you're at, and then you can kind of tailor your portfolio to meet those needs. Same thing here, types of investments. It's all in that risks kind of graph there: cash alternatives, bonds, stocks, other investments, funds. These are all types of plans, types of investment options that you're able to invest in depending on your risk tolerance. And that's where we come in, either from a personal investment standpoint. We'll kind of help craft the right portfolio for you, based on your risk tolerance and your long-term objectives, and craft it with a certain allocation towards some of these investment options. Or the same thing with John in his world in retirement. He can help a small business kind of craft their 401k menu of available options using mutual funds that kind of cater to some of these different types of investments. He's there to kind of help you through that process.
So one thing I want to point out about cash, that shortest term, lowest risk, lowest return potential is usually the asset class or the type of investment you want to minimize in your retirement holdings over time, because they're going to fare the worst over time against the effects of inflation.
Yeah, totally agree. And again, it goes on that risk scale, your time horizon, all those different pieces. We can all use those data points to kind of craft a portfolio. Somebody closer to retirement might be heavy more in bonds, cash alternatives, versus somebody that's just starting off might be more heavy in stocks and other types of funds. And this slide just kind of goes over some of the same details. Cash alternatives are relatively low risk, short term, and generally fairly liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternatives to provide you with relative stability, to maintain a ready source of cash for emergencies, or to serve as a temporary parking place for assets until you decide where to invest the assets otherwise. Some examples are CDs, money market deposit accounts, money market mutual funds, US T-bills. Each option offers different rates of return and varied levels of liquidity. So also some of these alternatives, such as bank CDs and deposit accounts, may offer some sort of FDIC insurance. Others do not. So you got to understand that as well and be cognizant of the different types of protection available. This goes over the, investing in cash alternatives are evident. You receive reliable, predictable earnings and an easily tapped source of funds with little risk to principal. The big trade-off here, though, as John mentioned, is that the return you'll receive on these investments is relatively low compared to the potential return offered by other investment options. In fact, the possibility exists that the return on these investments will not be sufficient to keep up with inflation, again, from our previous slide. So in that case, you'll actually lose purchase power over time. So again, this is usually a small part of what we use on clients' portfolios, depending on where they are and for their needs and their lifestyle. We kind of altered this part of their allocation at that point. Bonds are essentially loans, which is why they are called debt instruments. You, the investor, lend money to a government or a corporation. The interest rate or coupon rate, which can be fixed or floating, is set to advance, and interest payments are generally paid semi-annually. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, the maturity date is fixed, ranging from 1 to 30 years. However, bonds don't need to be held until they mature. Once issued, they can be traded among investors like any other type of security. Because you can buy or sell bonds in the open market, bond prices do fluctuate, selling at above or below their face value. So if interest rates are rising, new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest rates become less appealing. So when interest rates rise, existing bonds generally decrease in value. In contrast, when interest rates fall, existing bonds generally increase in value. So generally, the longer a bond's duration and maturity, the more volatile its price swings. Types of bonds include U.S. government securities, agencies, muni bonds, and corporate bonds. Bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks or commodity, but they're an important component of most investment portfolios. Bonds can provide steady and predictable stream of income through interest payments for as long as you hold them. In addition, the income from interest payments is typically higher than for cash alternatives. Bonds are generally considered relatively lower risk investments because bonds are legal debt obligations. Corporations must pay interest to bondholders before paying dividends to shareholders. Further, in the event a corporation declares bankruptcy or dissolves, it is obligated to pay bondholders before stockholders. And of course, securities issued by the Treasury are backed by the full faith and credit of the United States of America. However, all bonds carry some risk, and some bonds carry a great deal of risk. Bonds may also help you diversify your investment holdings. Funds values tend to move in the opposite direction of the stock market. By holding both bonds and stocks in a portfolio, you might be able to offset losses in one asset category with gains in another asset category. With a bond, you can lose money if the issuer fails to make interest payments or is unable to repay principal. Many bonds are issued with fixed interest rates. And finally, because bonds have relatively lower risk than other investments, they also tend to offer relatively lower returns. Stocks, and again, we're just going up the kind of the risk curve here. Stocks, when you buy a company stock, you're actually purchasing a share of ownership in the business. The greater the number of shares you own, the higher the percentage of ownership you have in the company. Investors who purchase stocks are known as the company's stockholders or shareholders. Your percentage of ownership in a company also represents your share of the risk taking and profits generated by the company. Beyond that, depending on the company and the types of shares you have, stock ownership may carry other benefits. Specifically, you may be entitled to dividend payments, capital gain payouts, and other corporate privileges. For example, common stockholders have the right to vote for candidates for the board of directors and other important issues. If you purchase stock, you can make money in one of two ways. First, corporate earnings may be distributed in the form of dividends, usually paid out quarterly. And secondly, you can sell your shares. If the value of the company stock has increased since you purchased it, you will make a profit. Of course, if the value of the stock has declined, you'll lose money. Common versus preferred. There's a couple of different types of stock. Common stockholders hold many rights, including the right to vote. However, common shareholders are last in line to claim the earnings and assets of the company. They receive dividends at the discretion of the board of directors and only after all other claims of profits have been satisfied. Stock is commonly categorized by the market value of the company that issues the stock. For example, large cap stocks describe shares issued by the largest corporations. Other general categories include small cap, mid cap, and micro cap. Stock is also commonly classified according to the characteristics of the company and for the expectation of investors. And some of the advantages of investing in stocks depend largely upon the stock or type of stocks that you choose. In general, stocks offer a greater potential for returns than do bonds or cash alternatives. Historically, that has been particularly true for long-term periods. With stocks, you actually own a share of the company and therefore have ownership rights that may include voting rights. You can invest in stocks that have a history of paying regular dividends. You can also invest in stocks that have the potential to appreciate significantly in value. The stock is easy to buy and sell. Of course, if the company you invest in performs poorly, it may not pay dividends, even if it had regular paid dividends in the past. More importantly, through poor performance, it will result in your shares losing value. In fact, your shares can lose value simply because they're subject to the general volatility of the stock market, which has experienced sharp declines in the past and like we said, over the last few months. The volatility means that your risk of losing principal is greater than stock than it is with bonds and cash alternatives. It also means that the stock may not be appropriate for short-term investment timelines unless you have a high tolerance for risk. So again, your long-term objectives, your short-term objectives need to be kind of classified, and that's where we kind of come up with a plan to kind of really help meet the short-term, medium-term, and long-term goals. So going into other investment options, there's real estate, stock option, futures, commodities, collectibles. Again, all of them have their own various degrees of risk. And as long as they're all part of a plan, it could make sense. Mutual funds. Mutual funds represent another way to invest in stocks, bonds, or cash alternatives. The principle behind a mutual fund is quite simple. Your money is pooled along with the money of other investors into a fund, which then invests in certain securities according to a stated investment strategy. The fund is managed by a fund manager who reports to a board of directors.
So one point about mutual funds, Sean, that is the most common investment vehicle available in retirement plans such as 401ks and 403bs.
Yeah, exactly. It's an easier way to invest for longer term in a 401k because there's more diversification, correct, John, in a mutual fund than having 5 stock options, 5 common shares issued in a 401k. So that's why mutual funds are the more appropriate investment for your 401k plan or 401k.
Exactly.
Mutual funds, every mutual fund publishes a prospectus. So before investing in a mutual fund, get a copy and review this information. It contains all the risks, all the fees, all the expenses, and carefully consider those factors as well as others before investing. And again, if you get a little confused in your 401k with all the different options, come to us, myself or John, depending on what side of the aisle you are in the sense of if you're a participant or you're the owner of the company, we can certainly kind of give you some guidance and help you there. So there's 3 major investment categories, cash alternatives, bonds, and stocks. Many mutual funds limit themselves to just one of these categories, commonly named and classified accordingly to their investment style or objective. Funds that invest solely in cash alternatives are generally called money market mutual funds. Funds that invest solely in bonds are called bond funds, and not surprisingly, funds that invest in stocks are called stock funds. These funds can also be classified based on the size of the companies which the fund invests, large cap, mid cap, small cap, things along those lines. Of course, there are many other types of mutual funds. Funds that invest in both bonds and stocks are often called balanced funds. There are mutual funds that fit all along the risk return spectrum. International funds would seek investment opportunities outside the United States are one example. An actively managed fund is one where the fund manager uses his or her knowledge and research to actively buy and sell securities in an attempt to beat a specific benchmark. A passively managed account called an index fund typically buys and holds most or all of the securities represented in a specific index. For example, the S&P 500, NASDAQ 100, things along those lines. Here's some other advantages and disadvantages, kind of what we discussed earlier. Diversification, you're able to get a lot more diversification through one mutual fund than buying one stock. It's professionally managed. There's small investment amounts in terms of the minimums. You can put smaller amounts to work. And also the liquidity. They're very liquid, just similar to shares of stock or bonds. Disadvantages, value of shares can fluctuate daily. Portion of fund dollars may be tied up in cash for liquidity needs, and potential tax inefficiency in mutual fund fees and expenses. And then the next category we're just going to quickly talk about are ETFs, exchange traded funds. Unlike actively managed mutual funds, exchange traded funds typically select investments according to a specific index, for example, the S&P 500. The fund's investment choices typically don't change unless the index itself changes. That passive management style and relatively infrequent trading can help reduce the fund costs for such things as management fees, research into individual securities, and trading fees for buying and selling individual securities. In this way, they are a bit like an index mutual fund. Even if ETFs have a passive management style, they can be useful to investors who want to trade actively. For example, an ETF can be traded throughout the day, and its price may fluctuate as a result of that activity, just as a stock does. This is different from a mutual fund, which is priced only once a day after the market closes. Also, an ETF can be bought on margin, sold short, and traded using stop orders or limit orders, just as stocks can. ETFs are one way to invest in an individual market segment or industry without limiting yourself to a single stock. So a lot of people might buy a gold ETF or a technology ETF to kind of focus on a specific sector. They also may provide better tax efficiencies than mutual funds do. Before investing as with mutual funds, before investing in an ETF, get a copy of the prospectus available from the fund and carefully review all the information that's in there, from its objectives to its risks, its fees, and expenses, and just make sure that it's kind of fitting in your overall strategy. Dollar cost averaging. Many investors utilize an investment strategy called dollar cost averaging. With dollar cost averaging, rather than investing a single lump sum all at once, you're able to invest smaller amounts of money at regular intervals, no matter how the market is performing. Your goal is to reduce the overall volatility of your portfolio by purchasing more shares when the price is low and fewer shares when the price is high. So, John, this is something that 401k is kind of made for this, correct?
Exactly. Yep, that's the most common example, because you're making investment contributions to your plan each payroll. So you're buying relatively small amounts over and over and over again throughout the year.
And the great thing about a DCA strategy as well is it takes out some of the emotion that trying to time the market or this and that. 401k is great because it's just constantly putting money into that 401k. And, buying low, sometimes you're buying high, but you're just constantly, putting money to work. And over the long term, it's usually a positive for most investors. So here's some of the asset allocation considerations. You want to have diversification, whether it be from assets of bonds or stocks, or just from different types of mutual funds or stock position, bonds positions. Your risk tolerance, that's another critical component that we mentioned earlier that you might want to go to our website to kind of get your own risk score and get an understanding of how much risk you can tolerate, especially with the volatile markets that we've been in. It's a very important type of thing to really drill down on. Time frames, very important to know if you're investing 1 to 2 years out, or if you're looking at 30, 40 years out. That will definitely help. Personal financial situation. You got to be able to invest what you are comfortable with and what you're able to. So you got to kind of budget and figure out those pieces. And then in liquidities for emergency purposes and other unexpected kind of hiccups, you want to make sure you have some money tied away in case, we go through another market tough point here of volatility and it brings down your portfolio, and you don't want to be selling at the lows because you didn't have enough liquidity tied away. And again, these are just some general ideas of conservative models. So a conservative asset allocation model will tend to focus on preserving principal. That's why you'll see the majority of the assets in bonds, only a quarter of the assets in stocks, and then cash alternatives, not 100% cash, but it's alternatives, which are, probably yielding a little bit more than a typical money market. And moderate, you get into a little bit more of a bigger stock allocation. Moderate allocation will tend to balance predictable income with potential growth. So you'll have, it's pretty much a split of 50 stocks, 50 bonds, but in reality it's 40 and 10. But everybody's moderate's a little bit different, but this is a general idea of how that would look. And then aggressive, you can obviously see an aggressive model has a lot more stock in it. This model tends to focus primarily on potential growth. Some models you see as high as 100% in stock. So those are some of the kind of components that you need to factor in. And again, timelines, risk factors, liquidity needs, those are all kind of the pieces that you should be considering and thinking when you're determining your investment strategy. And again, the role of a financial advisor, like myself on the individual side or John on the corporate, plan side, is, we can help you kind of visualize and determine your investment goals, timelines, risk and tolerance, evaluate markets and investments, create an asset allocation model, select specific investments, manage and monitor your portfolio, and, basically modify your portfolio when necessary. So, these are the pieces that can be interchanged on the corporate side as well as the individual side. So if you have a small business that doesn't have a 401k, or you're a small business owner and you want to know the best ways to save for retirement, talk to John. John has a great understanding of all the different ways for small business owners to invest for the long term, their retirement goals, as well as their retirement strategy. I don't know, John, if you wanted to add anything to that. But
yeah, there were a couple of mentions I wanted to drop. One is a program that we have for employers where we can arrange for supplementary contributions to the employees' retirement accounts via rebates on their everyday spending. And that program is called MyShare. And that's something that's very easy to implement alongside an existing 401k or 403b. And then in reference to some of the asset allocation conversation, we also have a program called MyRisk that can help an investor determine the right asset allocation for them based on their personal risk tolerance. So those are a couple of programs in what we call our My Series programs that can help with long-term dollar cost averaging and investment decision making.
No, great. So you have our contact information up here, so please feel free to reach out to us at any time. We will be more than happy to help. And again, if you just need to pick our brains on some individual questions or some corporate retirement questions, we're more than happy to help.
All right, Sean, thank you.
John and myself wanted to thank you for joining us today. And again, feel free to reach out to us, and we'll talk to you soon. Bye-bye.